Hey there, welcome back to my channel, Book Demystified. You know what? I just finished reading Tony Robbins' Money, Master the Game, and I'm absolutely blown away. This isn't just another finance book sitting on your shelf collecting dust. This is literally a roadmap that could change your entire financial future. And today, I'm going to break down the 7 life-changing steps that Tony Robbins discovered after interviewing 50 of the world's most successful investors and financial experts. Picture this. You're sitting at your kitchen table, maybe it's Sunday morning, you've got your coffee in hand, and you're looking at your bank account on your phone. Maybe you're feeling that familiar knot in your stomach because the numbers just aren't where you want them to be. Or maybe you're doing okay, but you know deep down that you could be doing so much better. You're not alone in this feeling, and here's the thing that's going to shock you. Most Americans, even those making 6 figures, are living paycheck to paycheck. Tony Robbins spent 4 years of his life obsessing over this exact problem. He interviewed billionaires like Ray Dalio, Warren Buffett, and Carl Icahn. He sat down with Nobel Prize winners and the most successful hedge fund managers on Wall Street. And what he discovered will fundamentally change how you think about money forever. Let me tell you something that's going to hit you right between the eyes. The average American household has less than $400 in emergency savings. $400. That's less than most people's monthly car payment. But here's what's even more mind-blowing. It's not because people don't make enough money. It's because nobody ever taught us the real rules of the money game. You see, there's this massive gap between what we think we know about money and what actually works. Most of us learned about money from our parents, who learned it from their parents, who probably lived through the Great Depression and buried their cash in coffee cans in the backyard. Or maybe you learned about money from some high school economics class where they taught you about supply and demand, but never once mentioned how compound interest could make you a millionaire. Tony Robbins realized that this financial illiteracy wasn't just an individual problem, it was a national crisis. And so he set out on this incredible journey to decode the secrets of the ultra-wealthy and make them accessible to regular people like you and me. The first thing that's going to blow your mind is what Tony calls the most important financial decision you'll ever make. It's not about picking the right stocks or finding the perfect investment property. It's about making the decision to become financially free. I mean, really making that decision. Not just hoping for it or dreaming about it, but deciding with absolute certainty that you're going to master this game. Think about it this way. Right now, you're probably spending more time planning your next vacation than you are planning your financial future. You'll research hotels for hours, compare flight prices, read reviews, but when it comes to your money, you just kind of wing it. You throw some money into your 401k because HR told you to, maybe you have a savings account that's earning practically nothing, and you cross your fingers and hope it all works out. But here's what the wealthy know that most people don't. Hope is not a strategy. Financial freedom isn't something that happens to you, it's something you create. And the beautiful thing is, once you understand these 7 steps, you'll realize that becoming financially secure isn't about making $1 million a year, it's about understanding how money really works. Let me share something with you that's going to change your perspective forever. Tony discovered that the difference between the wealthy and everyone else isn't intelligence, it's not luck, and it's not even about how much money you start with. The difference is that wealthy people understand the power of compound interest, and they use it to their advantage, instead of letting it work against them. Here's a story that'll illustrate this perfectly. Let's say you're 25 years old, and you decide to save just $50 a month. That's less than most people spend on their monthly Netflix, Spotify, and coffee subscription. If you invest that $50 every month and earn an average return of 7% annually, by the time you're 65, you'll have over $130,000. But here's where it gets crazy. If you wait until you're 35 to start, you'd have to save almost $100 a month to end up with the same amount. That's the power of compound interest, and it's working for you or against you every single day. When you carry credit card debt at 18% interest, compound interest is your enemy. When you invest in low-cost index funds, compound interest becomes your best friend.
But Tony didn't stop there. He wanted to know exactly how the world's most successful investors actually invest their money. And what he discovered is going to shock you, because it's probably the complete opposite of what you've been told. You've probably heard that you need to take big risks to make big money, right? Well, that's complete nonsense. The most successful investors in the world are actually obsessed with not losing money. Warren Buffett's #1 rule is, don't lose money. His #2 rule is, don't forget rule #1. Ray Dalio, who manages more money than almost anyone else on the planet, doesn't try to hit home runs. He focuses on consistent, steady returns while protecting his downside. These guys aren't gambling with their money. They're following a systematic approach that virtually guarantees success over time. Now, I know what you're thinking. This sounds great, but I'm not Warren Buffett. I don't have millions of dollars to invest. And that's exactly what makes Tony's approach so brilliant. He took these strategies that were previously only available to the ultra-wealthy and figured out how regular people can use them too. Hey, if you're enjoying our free book summaries and want to support what we do, there are a few easy ways to help. You can subscribe to the channel, become a member, or grab the book using our affiliate link in the description. And if you'd like to go a step further, you can also leave a tip via PayPal or UPI. The link's below. Every bit of support helps us keep creating valuable content for you. Now, let's dive into these 7 steps that could literally transform your financial life. And I want you to really pay attention here, because each step builds on the previous one, and together they create this incredibly powerful system for building wealth. Step #1 is what Tony calls, make the decision to become an investor, not a consumer. This might sound simple, but it's actually the hardest step for most people, because it requires a complete shift in mindset. Think about how you approach money right now. When you get paid, what's the first thing you do? If you're like most people, you pay your bills, you spend money on things you need and want, and then, if there's anything left over, maybe you save it. This is what Tony calls the consumer mindset, and it's keeping you broke. Investors think completely differently. They pay themselves first. Before they pay a single bill, before they buy anything, they automatically move money into their investment accounts. They understand that if they don't pay themselves first, they'll never build wealth because there will always be something else to spend money on. Here's a perfect example of how this works in real life. Let's say you make $4,000 a month after taxes. Most people would pay their $1,500 rent, their $300 car payment, their $150 grocery bill, and so on. Then they'd look at what's left and maybe save $50 or $100. But an investor would immediately move $400 into their investment account the moment they got paid. Then they'd figure out how to live on the remaining $3,600. It's a complete reversal of priorities, and it's incredibly powerful because it forces you to be more intentional about your spending. Now, I can already hear some of you saying, but I can't afford to save $400 a month. And you know what? You're probably right. But here's the thing. You don't need to start with $400. You could start with $10. The amount doesn't matter as much as developing the habit. Tony tells this incredible story about a man named Theodore Johnson. Theodore was a UPS driver who never made more than $14,000 a year. But he had this simple strategy. Every time he got a raise, he'd save half of it. When he retired, he was worth $70 million. $70 million from a UPS driver's salary. This is the power of making the decision to become an investor. It's not about the amount you start with, it's about the habit you develop and the consistency you maintain. Step #2 is become the insider, know the rules before you get in the game. This is where most people completely mess up their financial future, and it's not their fault. The financial industry has created this incredibly complex system that's designed to confuse you and separate you from your money. Here's something that's going to anger you. The average American pays over $150,000 in fees to financial advisors and mutual fund companies over their lifetime. $150,000. That's enough to buy a house in many parts of the country, and you're just giving it away to Wall Street.
But here's what's even more infuriating. Most of these financial advisors and mutual fund managers can't even beat the market. Studies show that over any 15-year period, less than 5% of actively managed mutual funds outperform a simple index fund. Yet they're charging you fees that are often 20 to 30 times higher than what you'd pay for an index fund. Tony interviewed Nobel Prize winner Eugene Fama, who revolutionized our understanding of how markets work. Fama's research shows that markets are incredibly efficient, which means that all available information is already reflected in stock prices. This makes it virtually impossible for anyone to consistently beat the market over long periods of time. So why do so many people still pay these ridiculous fees? Because they don't understand the rules of the game. They think they need someone to actively manage their money, when in reality, they'd be better off just buying a simple index fund and holding it forever. Let me give you a concrete example of how devastating these fees can be. Let's say you invest $100,000 in a mutual fund that charges a 2% management fee. Over 20 years, assuming a 7% annual return, you'd end up with about $230,000. But if you invested that same money in an index fund that charges only 0.1% in fees, you'd end up with over $300,000. That's a difference of $70,000 just in fees. This is why Tony is so passionate about educating people about fees. He calls them the great wealth killer, and he's absolutely right. Understanding fees alone could add hundreds of thousands of dollars to your retirement account. But it's not just about fees. You also need to understand the different types of accounts available to you. Most Americans are leaving massive amounts of money on the table because they don't understand the tax advantages of different retirement accounts. For example, if you're not maxing out your 401k match, you're literally leaving free money on the table. If your employer matches 50 cents for every dollar you contribute up to 6% of your salary, and you're not contributing at least 6%, you're essentially giving yourself a pay cut. Then there are Roth IRAs, which are one of the most powerful wealth-building tools available to Americans. With a Roth IRA, you pay taxes on the money you contribute, but then it grows tax-free forever. And when you retire, you can withdraw all of it without paying a penny in taxes. Think about how powerful this is. If you're in your 20s or 30s and you contribute to a Roth IRA for the next 30 or 40 years, you could easily have $1 million or more that you can withdraw completely tax-free in retirement. That's like having a guaranteed lottery ticket that pays off decades later. Step number 3 is make the game winnable, the most important investment decision you'll ever make. This step is all about asset allocation, which is just a fancy way of saying how you divide your money between different types of investments. Here's something that's going to surprise you. Your asset allocation is more important than which specific investments you choose. Studies show that over 90% of your investment returns come from how you allocate your money between stocks, bonds, and other asset classes, not from picking individual stocks or trying to time the market. Tony discovered this by interviewing Ray Dalio, who's considered one of the greatest investors of all time. His hedge fund has made money in 23 of the last 28 years, which is almost impossible to do. And his secret isn't picking amazing stocks or having some crystal ball about the future. His secret is what he calls all-weather investing. The all-weather strategy is designed to perform well in any economic environment. It doesn't matter if we have inflation or deflation, economic growth or recession, rising interest rates or falling interest rates, the portfolio is designed to weather any storm and still provide positive returns. Here's how it works. Instead of putting all your money in stocks and hoping for the best, you diversify across different asset classes that perform well in different economic conditions. You might have some stocks for growth, some bonds for stability, some commodities for inflation protection, and some international investments for global diversification. But here's the key. You don't just randomly decide how much to put in each category. You use a systematic approach based on historical data and economic principles. For example, you might put 30% in stocks, 40% in long-term bonds, 15% in intermediate-term bonds, 7.5% in commodities, and 7.5% in international stocks.
The exact percentages aren't as important as the principle. You're spreading your risk across different types of investments so that when one goes down, others might go up. This smooths out your returns and reduces the volatility of your portfolio. Now, I know some of you are thinking, but I want to make big money fast. This sounds too conservative. And I get it. We live in a culture that celebrates the big win, the home run, the overnight success. But here's what Tony learned from interviewing the world's most successful investors. They're not trying to hit home runs. They're trying to consistently get on base. Think about it this way. If you can consistently earn 8% per year on your investments, you'll double your money every 9 years. That might not sound exciting, but it's incredibly powerful when you let it compound over time. Someone who starts with $10,000 at age 25 and earns 8% per year will have over $200,000 by age 65, even if they never add another penny. But here's where it gets really exciting. If that same person adds just $200 per month to their investment account, they'll have over $1.7 million by retirement. That's the power of consistent investing combined with compound interest. The key is to find an asset allocation that you can stick with through good times and bad times. Because here's what's going to happen. There will be times when your investments go down. Sometimes they'll go down a lot. In 2008, the stock market fell by almost 40%. But the people who stuck with their plan and kept investing eventually came out ahead. This is why Tony emphasizes the importance of making the game winnable. You're not trying to beat the market or get rich quick. You're trying to build a portfolio that will steadily grow over time, regardless of what the economy does. Step number 4 is make the most important financial decision of your life, the power of compounding. This is where everything we've talked about so far comes together into something truly magical. Albert Einstein supposedly called compound interest the 8th wonder of the world. He said, "He who understands it earns it. He who doesn't pays it." And this is absolutely true. Compound interest is either working for you or against you every single day. And the difference between the two scenarios is literally the difference between financial freedom and financial slavery. Let me tell you a story that perfectly illustrates this principle. There were two friends. Let's call them Sarah and Mike. Sarah started investing $100 a month when she was 22 years old. She did this for 10 years, then stopped completely. She never added another penny to her investment account. Mike, on the other hand, waited until he was 32 to start investing. But then he invested $100 a month for the next 33 years, all the way until retirement. Who do you think had more money when they both turned 65? Sarah, who invested for only 10 years, or Mike, who invested for 33 years? The answer is going to shock you. Sarah had more money even though she invested for less than 1/3 the time that Mike did. How is this possible? Compound interest. Sarah's money had an extra 10 years to compound, and those 10 years made all the difference. This is why Tony calls starting early the most important financial decision you'll ever make. But here's the thing. It's never too late to start. Even if you're in your 40s or 50s, you can still harness the power of compound interest. The key is to start right now, today, not tomorrow or next month or next year. Let me give you another example that shows how powerful this can be. Let's say you're 35 years old and you start investing $300 a month. If you earn an average return of 7% per year, you'll have over $700,000 by the time you're 65. But if you wait just 5 years and start when you're 40, you'd need to invest almost $450 a month to end up with the same amount. This is why Tony is so passionate about getting people started as early as possible. Every year you wait costs you tens of thousands of dollars in potential wealth. But compound interest isn't just about investment returns. It's also about compound learning, compound relationships, and compound habits. When you develop the habit of investing regularly, you're not just building wealth, you're building discipline, patience, and financial intelligence. You start to see opportunities that other people miss. You become more aware of fees and taxes. You start to understand economic cycles and market psychology. All of these skills compound over time, making you a better investor and a wealthier person.
There's also something called the compound effect in your daily habits. If you can improve your financial habits by just 1% each day, those small improvements compound into massive changes over time. Maybe you start by saving an extra $5 a day. That's only $150 a month, but over 30 years, that could be worth over $300,000. Step number 5 is create a lifetime income plan, the dream of financial security. This is where we start talking about turning your wealth into actual financial freedom. Because here's the thing, having $1 million in your investment account is great, but it doesn't mean you're financially free unless you know how to turn that money into a reliable income stream. Tony discovered that most people have no idea how much money they actually need to retire. They just pick some random number like $1 million and hope it's enough. But the wealthy think about it completely differently. They don't think about a lump sum of money. They think about cash flow. Let me ask you a question. Would you rather have $1 million in the bank Or would you rather have $5,000 coming in every month for the rest of your life, guaranteed? Most people would choose the $1 million, but that's actually the wrong answer. $5,000 a month for 30 years is $1.8 million. And if you live longer than 30 years, you keep getting paid. This is why Tony emphasizes the importance of creating multiple income streams. The wealthy don't rely on just one source of income. They have their investment portfolio, but they also have rental properties, business income, royalties, and other sources of passive income. One of the most powerful concepts Tony teaches is called the 4% rule. This rule says that if you have a well-diversified portfolio, you can safely withdraw 4% of your portfolio value each year without running out of money. So if you have $1 million invested, you can withdraw $40,000 per year, adjust it for inflation each year, and your money should last for at least 30 years. But here's what's even better. If you're earning more than 4% on your investments, your portfolio will actually continue to grow even while you're withdrawing money from it. This means you could potentially leave a larger inheritance to your children while still enjoying financial freedom during your lifetime. The key is to build your portfolio to a point where 4% of its value covers all of your living expenses. So if you need $60,000 per year to live comfortably, you'd need $1.5 million in your portfolio. If you need $80,000 per year, you'd need $2 million. This might sound like a lot of money, but remember what we learned about compound interest. If you start early and invest consistently, reaching these numbers is absolutely achievable for most people. Tony also talks about the importance of having different buckets of money for different time periods. You want to have some money that's very safe and liquid for emergencies and short-term needs. This might be in a high-yield savings account or short-term CDs. You want to have some money that's moderately aggressive for medium-term goals. And you want to have some money that's very aggressive for long-term growth. The exact allocation depends on your age, your risk tolerance, and your financial goals. But the principle is the same. You want to match your investments to your time horizon. Money you need in the next 5 years should be invested very conservatively. Money you won't need for 20 or 30 years can be invested much more aggressively. Step number 6 is invest like the 0.0001%. This is where Tony reveals the actual strategies used by the world's most successful investors. And what he discovered is going to change how you think about risk and return forever. The first thing you need to understand is that billionaires don't invest the way most people think they do. They're not day traders trying to make quick profits. They're not constantly buying and selling stocks based on the latest market news. They're patient, disciplined, and incredibly focused on protecting their wealth. Warren Buffett, who's worth over $100 billion, has never used a computer to analyze stocks. He doesn't follow the daily market fluctuations. He doesn't even have a smartphone. His investment strategy is beautifully simple. He buys great companies at reasonable prices and holds them forever. But here's what's really interesting. Buffett's actual returns aren't that much higher than the market average. His compound annual return over the past 50 years is about 20%, compared to about 10% for the overall market. That extra 10% doesn't sound like much, but when you compound it over 50 years, it turns into billions of dollars.
This is why consistency is so much more important than trying to hit home runs. If you can consistently earn just 2 or 3% more than the market average, you'll end up with dramatically more wealth over time. Ray Dalio, who manages more money than almost anyone else in the world, has a completely different approach. He uses something called principled thinking to make investment decisions. Instead of trying to predict what will happen in the future, he studies historical patterns and economic cycles to understand what might happen. Dalio's approach is based on the idea that there are only a few basic economic cycles that repeat over and over again. There are debt cycles, business cycles, and political cycles. By understanding these cycles, you can position your portfolio to benefit regardless of what happens in the economy. For example, during periods of economic growth, stocks tend to do well. During periods of economic decline, bonds tend to do well. During periods of inflation, commodities tend to do well. By having some of each in your portfolio, you're protected no matter what happens in the economy. But here's the key insight that Tony learned from interviewing all these billionaires. They all focus obsessively on asymmetric risk. This means they look for investments where the potential upside is much larger than the potential downside. Let me give you an example. Let's say you find an investment where you could lose 10% of your money, but you could potentially make 50%. That's asymmetric risk. Your potential gain is 5 times larger than your potential loss. Even if you're wrong half the time, you'll still come out ahead. This is how venture capitalists make money. They know that most of their investments will fail, but the ones that succeed will make up for all the failures and more. They might invest in 10 companies, lose money on 8 of them, break even on 1, and make 10 times their money on the last one. Overall, they come out way ahead. You can apply this same principle to your own investments. Look for opportunities where the risk is limited, but the potential reward is substantial. This might be investing in emerging markets, small-cap stocks, or new technologies. The key is to only invest money you can afford to lose, but to make sure the potential rewards justify the risk. Another principle that all successful investors follow is diversification. But not just diversification across different stocks. Diversification across different asset classes, different geographic regions, and different time periods. Most people think diversification means owning a bunch of different stocks. But if all your stocks are in the same country, the same industry, or the same asset class, you're not really diversified. True diversification means spreading your risk across investments that don't move in the same direction. For example, when stocks go down, bonds often go up. When the dollar gets weaker, international investments often do better. When inflation rises, commodities often perform well. By having some of each in your portfolio, you're protecting yourself against any single economic event. The final principle that Tony learned from studying billionaires is the importance of continuous learning. Every successful investor he interviewed was obsessed with learning and improving. They read constantly, they ask questions, they seek out new information and different perspectives. Warren Buffett reads for 5 to 6 hours every day. Ray Dalio has written detailed principles about everything he's learned from his mistakes. Carl Icahn studies companies more intensively than most people study for their college exams. This continuous learning isn't just about investment strategies. It's about understanding human psychology, economic cycles, business models, and technological trends. The more you understand about how the world works, the better investor you'll become. Step number 7 is just do it, enjoy it, and share it. The real wealth. This final step is about taking action and actually implementing everything you've learned. Because here's the truth. Knowledge without action is worthless. Tony discovered that most people never take action on what they learn. They read books, they attend seminars, they watch YouTube videos, but they never actually change their behavior. They suffer from what Tony calls analysis paralysis. They keep researching and learning, but never start investing. The biggest obstacle to financial success isn't lack of knowledge, it's lack of action. You don't need to be an expert to start investing. You don't need to have thousands of dollars. You don't need to pick the perfect investment. You just need to start. Here's what Tony recommends as your first step. Open an investment account today. Not tomorrow, not next week, not next month, today. You can do this online in about 15 minutes. Most major brokerage firms like Vanguard, Fidelity, and Charles Schwab have no minimum balance requirements and no account fees.
Once you have an account, start with a simple, low-cost index fund that tracks the total stock market. Something like VTSAX from Vanguard or FXAIX from Fidelity. These funds give you instant diversification across thousands of companies for an incredibly low fee. Set up an automatic investment plan so that money is transferred from your checking account to your investment account every month. Start with whatever amount you can afford, even if it's just $25. The amount doesn't matter as much as developing the habit.
As you learn more and your income grows, you can increase your contributions and add other types of investments. But the key is to start now, even if you don't feel ready. Tony also emphasizes the importance of enjoying the journey. Building wealth shouldn't be about depriving yourself of everything you enjoy. It should be about making smart choices so that you can afford the things that are truly important to you. This is where budgeting comes in. Instead of thinking about budgeting as restricting your spending, think about it as directing your spending toward the things that matter most to you. Maybe you spend less on eating out so you can spend more on travel. Maybe you buy a used car instead of a new one so you can invest more money. The key is to be intentional about your spending. Every dollar you spend is a choice. You're choosing to spend it on that thing instead of investing it for your future. Sometimes that's the right choice. Sometimes it's not. But at least you're making a conscious decision. Tony tells this amazing story about a couple who decided to track every penny they spent for 1 month. They were shocked to discover that they were spending over $800 per month on things they didn't even remember buying. Coffee here, lunch there, a few items at Target, some apps on their phone. It all added up to a significant amount of money. They didn't cut out all of these expenses, but they became much more intentional about their spending. They kept the coffee purchases that they really enjoyed and cut out the ones that were just mindless habits. They continued eating out at restaurants they loved, but stopped buying expensive lunches at work. These small changes freed up almost $400 per month that they could redirect toward their financial goals. This is the power of conscious spending. You're not depriving yourself. You're making sure your money goes toward the things that actually bring you joy and move you closer to your goals. The final part of Step 7 is about sharing your wealth. Tony discovered that the happiest wealthy people are those who use their money to make a positive impact on the world. This doesn't mean you have to give away all your money. It means using some of your wealth to help others. This might mean contributing to charities you believe in, helping family members with their education, or starting a scholarship fund. It might mean investing in businesses that create jobs in your community, or supporting causes that are important to you. The beautiful thing about sharing your wealth is that it creates a positive feedback loop. When you help others succeed, you feel more fulfilled and motivated to continue building your own wealth. And when you share your knowledge about money and investing, you help create a more financially literate society, which benefits everyone. Tony also talks about the importance of teaching your children about money. Most parents are uncomfortable talking about money with their kids, but this is one of the most important gifts you can give them. Kids who learn about money early in life have a huge advantage over those who don't. You can start teaching kids about money as early as age 5 or 6. Show them how compound interest works by letting them earn interest on their allowance. Teach them about needs versus wants by having them make choices about how to spend their money. Help them start a small investment account so they can watch their money grow over time. The goal isn't to make your kids obsessed with money. It's to give them the tools they need to make smart financial decisions throughout their lives. Kids who understand money are less likely to make costly mistakes as adults, and they're more likely to achieve financial freedom. As we wrap up, I want you to think about where you'll be financially 5 years from now if you implement these 7 steps. Imagine having a growing investment portfolio, multiple income streams, and the knowledge and confidence to make smart financial decisions. Imagine not worrying about money anymore because you know you're on track to achieve financial freedom. But more importantly, imagine the impact this will have on your family, your stress levels, and your overall happiness. Money problems are one of the leading causes of divorce, anxiety, and depression. When you master the game of money, you're not just improving your bank account, you're improving your entire life.
The 7 steps Tony Robbins outlines in Money Master the Game aren't just theoretical concepts. They're practical strategies that have been tested by some of the most successful people in the world. The decision to become an investor instead of a consumer. Understanding the rules of the game so you don't get taken advantage of. Creating a winnable asset allocation strategy.
harnessing the power of compound interest, building multiple income streams, investing like the ultra-wealthy, and, most importantly, taking action on what you've learned. Remember, you don't have to be perfect. You don't need to implement all 7 steps at once. You just need to start. Pick one step that resonates with you and take action on it today. Maybe it's opening an investment account. Maybe it's calculating how much you need for retirement. Maybe it's simply deciding to become an investor instead of a consumer. The most important thing is to start moving in the right direction. Every day you wait is a day that compound interest isn't working in your favor. Every month you delay is potential wealth that you're giving up. But every dollar you invest today is a dollar that could potentially grow into $10 or $20 or even $50 by the time you retire. Your future self will thank you for the actions you take today, and your family will benefit from the financial wisdom you gain and pass on to them. This isn't just about money. It's about creating a legacy of financial intelligence that can impact generations. So here's my challenge to you. Before you go to bed tonight, take one concrete action toward your financial future. Open an investment account, calculate your net worth, read one chapter of a finance book, or simply write down your financial goals. It doesn't have to be big, it just has to be something. Because here's the truth that Tony Robbins learned from interviewing 50 of the world's most successful investors. The difference between the wealthy and everyone else isn't talent, luck, or intelligence. It's action. The wealthy take action on what they learn, while everyone else just thinks about it. You now have the same knowledge that billionaires use to build and protect their wealth. The only question is, what are you going to do with it? Thank you so much for watching, and remember, your financial future is in your hands. Make it count.